Not perhaps the most beloved space in the mining industry, but I'm going to get into why it's something you should pay attention to here. And I can tell you we did due diligence on basically every zinc project globally, and Tinka was always the closest peer to what we had, and it was always the project that I thought had the best chance of being one of the next big zinc producers globally. At the same time, a good friend of mine, Michael Horner, who some of you may know, he was CFO of Adriatic Metals. They got bought by Dundee Precious last year, so that was about a $2 billion deal. Also, you know, zinc, silver, so he knew the space as well. We're good buddies, and we had looked to collaborate on something, so we wanted to do something together. At the time, as the Dundee Precious Adriatic deal was going through, Tinka was in a bit of a spot because their largest institutional shareholder decided that they were at the end of their fund life and they're going to exit through the market. So the share price took an absolute beating, and it unfortunately damaged, you know, the credibility in the markets and made it challenging for them to raise the capital to keep the business going. So Michael Horner and I approached the company with some backing from Adriatic and previous Adriatic shareholders and previous Fireweed shareholders, and offered to recapitalize the company, join the board, and push it in a new direction. And so what I'm going to kind of get into here is, you know, what is that direction? Why do we pick this project? Why, when, you know, I took a year's sabbatical after Fireweed before getting involved deeply into anything, why I chose this specifically despite all the opportunities available to me. So a bit of preamble first. I mean, this is kind of funny that I'm starting with a metal slide, because I've historically always said that any company that starts with a slide on their metals before they talk about their project, it's because they have a bad project. But I recognize this is a generalist audience, so I'm going to touch quickly on the primary metals that Tinka is, you know, aspiring to produce. So zinc has, you know, often been branded as like the original critical metal. It's something that perhaps doesn't come up in day-to-day conversation, but it's fundamentally an infrastructure metal, right? So this is bridges, also automobiles, you know, new uses for etc. in wind towers and solar plants, etc. But, you know, the interesting thing about zinc, which I'm going to get to a little bit in the future, you know, in a few slides down, is that I would not argue, you know, as John said, that there is an extremely exciting future in terms of demand for copper. There is as well for zinc, but I think what's interesting about zinc is the supply side and how dire the supply side is and how bare the cupboard is and how few quality development projects are out there. At the same time, Tinka, this is a polymetallic deposit, so we're fortunate that, one, we have an extremely large silver credit, which has gone from a, you know, small percentage of the potential revenue of a mine here to now a potentially very significant share of the mine here. We also have a geologically discrete tin zone, which actually sits as one of the largest undeveloped tin deposits in the world, which was actually a bit of an afterthought, found accidentally, and is now something that we can continue to look to grow. And I think if you follow, you know, Adrian, myself, and others on Twitter, you'll see around the periphery these perhaps slightly unhinged tin barons who will tell you about, you know, the great future of tin and how important it is in modern circuitry, electronics, and what the AI/electrification revolution is going to do to tin. So, you know, look, when we looked at these projects that I could have been involved in and that Michael Horner and I were looking at to decide how do we want to get involved, you know, what stood out about Tinka is the flagship project, Ayahuasca. This is central Peru. I'll show you a map in a second here. It was not just that Ayahuasca was big. I think to generalist investors, the parts of mining that are very easy to understand in terms of deposit, you know, appeal, obviously big, who doesn't like big, high grade, who doesn't like high grade, and there's a whole lot of stuff after that becomes increasingly difficult to understand, right? So as a generalist, big and high grade, easy to understand, but there's a lot more to it than that. And what we saw at Ayahuasca was a lot of optionality in terms of how we approach the development path line, how some underexplored sort of secondary deposits, for example, the Colquipucro silver deposit, could potentially boost the economics. And I think most interesting, you know, coming from a project that was in the middle of nowhere in Arctic Canada to somewhere that's very well situated in Peru. It's a world of difference in terms of buildability and infrastructure. So, 250 kilometers by paved roads to Cajamarquilla, the zinc refinery owned by Nexa, just outside of Lima, Nexa being one of our largest shareholders. We have a handful of mining going on around us. We are not far from the ports either at Lima or the new Chankay Chinese-owned port north of there. High voltage power lines going through the project. We already have the rights to that power. Adequate water supply, no community issues, all these sort of things that perhaps are not on your first pass for due diligence, but when you're considering like, okay, if I actually want to build this mine, if I don't just want a sexy promotable resource, if I actually want to, God forbid, put your big boy pants on and build something, you need to consider all these different things. And for us, it was great to be in a region, you're surrounded by operating mines. So our two biggest shareholders are Buenaventura and Nexa. So you have in the lower left corner of the southwest, two Buenaventura mines. You have in the east there, two mines operated by Nexa. Nexa also operating that big smelting complex outside of Lima. And I think actually extremely interesting, which the savvy shareholders picked up, was that the Raura mine, which was 35 kilometers to the west of us, accessible by road between the two of them, was just sold to China Non-Ferrous. China Non-Ferrous, if you don't know, is one of the big, gorillas of the state-owned enterprises in mining in China. They do not acquire a mine like Raura, which honestly is a bit of a consolation prize. It's not a big mine. It's not got a lot of mine life. The reason they acquired it is because they are absolutely desperate for zinc concentrate. So they have these smelting complexes in China. They need to fill these smelting complexes with concentrate because they take metal from mines and most mines ship a concentrate, which is something around 50 to 62% zinc. They send it to the smelter, which produces the pure zinc metal. Smelters, like a lot of operations, but especially so, the profit margin is largely driven by whether or not you're at capacity. If you're operating at 30, 40, 50, 60% capacity, it is very difficult to make a go of it. So what we're seeing globally, and this is happening in zinc, it's happening in copper, is that there are these nation-building exercises of, we want our metal security, we want security of supply, we want local smelters. So they either refuse to shut down smelters that have an adequate feed, or they're building new smelters with no clear view of how they get the feed for them. So this leads to big companies like China Non-Ferrous buying operations in Peru for their first foray into Peru because they are so desperate for feed. So we see, with Raura only having about 7-8 years of reserves left, obviously Ayahuilca could be an amazing bolt-on for that. But that's not, I think every junior aspires to prove up a great resource and sell it because your life is a heck of a lot less complicated if you don't have to build. And the truth of the matter is that the construction and commissioning is the most risky phase of a mining project's life cycle, right? You've got this brand new fresh debt and you do not yet have steady state cash flows. So the last preliminary economic assessment, which is an early stage economic study done on the Ayahuilca project, produced very good economics, and I would note a couple things here, that those used metal prices significantly less than we are now. I did this slide earlier this week when silver was 75. I don't know what it is now, like 65 or something. We're obviously in a bit of a free fall situation, but I think a couple things that, the silver regime is radically different than it was before, and I don't think it's going back to sub $50 or even $40 silver prices. The tin price has more than doubled. Actually, it's more than doubled since I've joined the company, right? It was interesting. When we joined, we kind of thought the tin zone was maybe a bit of an afterthought, but now it's suddenly looking a lot different. But critically, I think when they did this 2024 PEA, they did what they approached it with a philosophy, what I would call NPV maximalism. Like how do I get the biggest NPV possible? And I think it's very easy to say, well, isn't the biggest NPV the best project? Maybe, right? So the question is, okay, so that's the NPV at final investment decision, your FID. But how long does it take you to get to FID? How much money do you have to spend to get to FID? How much risk is implicit in that construction? Is your permitting going to be more at risk or more complicated because you've decided to go with a bigger scope? And one of the things that, Michael and I really focused on when we joined Tinka was that there is a very big resource here that is, on average, higher than the average grade of a zinc mine globally. But critically, there was core zones that had much higher grade on average than the average deposit across all of it. So we kind of reflected upon it and thought there is probably a smaller operation here, not a lot smaller, but a little bit smaller, that is leaner and meaner and much higher margin. So the critical parts of that are going to be the west and south zones. These have very discrete, very cohesive, high-grade zones, mostly zinc, that could be exploited perhaps initially to keep the grade high. The tin zone now, that has a raw rock value, a sort of value per ton, much higher than the average. There are these discrete silver zones, these silver veins that are geologically different but related to the zinc zones. The one in the south has a little bit of a resource on it. The silver zone to the north has no resource on it, was not included in our last resource statement or the last economics. So there's a lot of ways that we can take what was good economics, but make it tighter, make it better. How do we improve that NPV to CapEx ratio? So one of the ways, for example, is in the, this is west as an example of what you would also see in the south zone. So you have these cohesive high-grade zones. As you saw from the last slide, the average of the deposit is about 6% zinc and change, but you're getting here many intersections, multiples of that are significantly higher. And so the challenge is when you build a really big mine, that your mill, like the smelters are hungry for concentrate, when you build a big mill, your mill is hungry for ore, right? It needs that material. And so when you build a bigger mill or overscope the mill, you inevitably have to perhaps feed into it lower grade material to keep it at capacity. So this is part of what we are trying to review now is, okay, well, let's reduce the scale of the mill. Not down 75% or even 50%, but if we reduce the size of the mill, say 30% or 40%, can we keep the grade higher and keep our margin higher? And part of that may also be looking at these silver zones, and these are geologically discrete, like I said, silver veins that grade significantly higher in terms of economic value than a lot of the zinc zones, and could be certainly part of the way we recast this. And perhaps most unexpectedly, adjacent to the Iowilca deposit is a secondary deposit called Colquipucro. This was actually the original deposit that Tinka was launched on. They found Iowilca subsequently and focused on that. This has not had any work done on it since 2016. That's when that's when silver was $18 an ounce. This is a open pittable, very low strip silver oxide deposit, not incredibly large, but we think about it now, looking at it through the lens of this as a district as opposed to standalone deposits. Can I use this as a very low CapEx way to bootstrap the district? Because this would be something that would presumably be, half or less the price of Iowilca to build, yet can produce very good cash flow for sort of, 5 to 7 years, which could allow you to build the rest of the mine. There's a lot of ways to think about it, and I think critically, for me, we want to keep our options open as long as possible. Eventually, the permitting authorities require you to be very specific about what you want to build, and then you have to very specifically build that thing, right? So you cannot keep all options open forever. But, we're progressing this forward towards production now. We recognize that the company was trapped in a cycle of being a perpetual explorer, and I would argue that if you have no intention to advance the project or you have no capacity, you run that risk of just stalling out completely. So the key focus is from the company, what we're tweaking the company and moving towards doing is going from let's just explore forever. Maybe if we get big enough, someone buys us, to instead, all right, well, let's advance meaningfully towards production. So that means, start working on engineering, start working on your infill drilling. We're renewing all our community agreements right now. Secure your surface rights. All these things that to a lot of the dyed-in-the-wool mining investors are perhaps not as sexy as drill results, but they ultimately move an asset towards production. So we're currently internally looking at scenario analysis. So sort of how do we, what are the various ways we can do this? Is a small high-grade zinc operation the right way to start? Do we start at Colquipucro? Do we go right to the tin zone? What are the ways to look at this? So we're looking at that now. That's going to feed into a drill program this summer, and probably starting in about July, August, that drill program. And I think we're in a bit of a lull right now because we don't have a lot to say for ourselves until the community agreements are done in May and June. But once that's done, this is going to be a very busy time for us, a lot of news flow, a lot of catalysts. And I think what we're going to be able to do is spell out to the market what our 3-year plan is to get this thing built, and then start hitting those milestones and make everyone a believer. So I'll turn it over to questions.